Hello, Accounting 442. This is chapter 14. Let me share my screen. Property transactions, determination of gain or loss, and basis considerations. So this is gain or loss is very similar to what you would learn in intermediate accounting. Okay. What is a gain or a loss? Okay. So let's talk about the taxation of that, but we're really not. We're going to talk more about what is basis. Okay. So, by the end of this chapter, you should be able to compute the realized gain or loss on a property disposed, the realized gain. Then know the difference between a realized and recognized gain or loss. Now, a realized and recognized gain for GAAP is different than a realized and recognized gain for tax. It's different. What are the various methods of asset acquisition? What is the loss disallowance provision? And then tax planning. So our big picture. Alice owns a house that she received from her mother, Paula, 7 months ago. Paula paid $275,000 for that house. So that would be Paula's basis, her beginning basis. Basis is, what did you get it for? Now, when we think about Paula back in the day when she bought this house, she went out looking for a house, found the house. It's on sale for $275,000. That's the market value. It's fair market value. Sorry, that's my dog. Once she owns it, that fair market value now becomes the basis or the book value. Okay, so Alice is considered selling the house to her favorite nephew, Dan, for $275,000. So Alice might be thinking, oh, $275,000, no gain or loss, no taxes on the gain. But when did she buy this house? How long ago was it? That's her basis. What's the rule about basis transferring to Alice? Is she getting the $275,000 or is she getting the fair market value of the house at the time of when she received it? So there's all these different questions we have to ask. Okay. So because she's saying this $275,000, she thinks that she'll have no gain or loss, but we need to learn what the actual rule is with how you transfer these types of assets. So Alice comes to you for advice. Yeah. Alice comes to you for advice. As her tax advisor, you need to answer the following questions. You are aware that Alice's mother, Paula, died around the time Alice received the house from her. So did she receive the house by a gift before the mother's death? If so, what was the mother's adjusted basis? So I said that her basis when she bought the house was $275,000, but what's the adjusted basis for the house? And when did she buy it? We'll talk about what adjusted basis is. Did Alice instead inherit the house from her mother? So did she receive it as a gift before her mom died, or did she inherit it after the mother died? If so, what's the fair market value of the house? So here's the basis versus the fair market value. So we're going to look at the rules as to what you use to value it. So the other, is the house Alice's principal residence? Has she lived in the house? How long did she live in the house? Was it before or after she received it from Paula? There's a rule with regard to time. We'll learn about that. To help determine the tax consequences for Alice's potential sale of the house to her nephew, Dan, you need to answer the questions. What's the current fair market value of the house? What does Alice intend to do for the transaction with Dan to be a sale or a part sale or part gift? What does Alice intend to do with the sale proceeds? She also has a boat that she wants to sell, and she wants to know what the tax consequences are for that. She bought the boat for $22,000, and she only had it for personal use. She didn't have it for business use. She's been disappointed with it, doesn't like the layout or capacity, and she'd like to sell it. She wants to sell it between 20 to 23. If she sells it for $20,000 and she paid 22, there'll be a loss. If she sells it for 23, there'll be a gain. Well, if there's a loss, is she allowed to deduct that loss? And if it's a gain, does she have to pay taxes on that gain? Okay. And the last is, while you're talking to her, Alice mentions that earlier this year she sold some stock in Green Corporation at a loss. A few days later, after hearing Green's quarterly earnings report, she decided to buy back the shares. So we're going to talk about buying back shares in a wash sale. Okay, so those are the facts. So determining a gain or loss. A realization. A realization is, for tax purposes, what you would have had as a gain or a loss. Okay? Recognition is, how much are you going to actually put on your tax return? So I sold a house and I made $50,000. That's, you realize the $50,000. But for tax purposes, the recognition is based on the rule of the type of property and blah, 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 exclusions. Does that $50,000 of gain have to go on your tax return or not? If it does go on your tax return, that's recognition. So realization means you have a significant change in ownership, and once the realization has occurred, a gain or a loss is determined. So I bought something for $100,000. I sold it for 60. 100 minus 60 is 40. I have a $40,000 loss. If I bought something for 60,000 and I sold it for 100, I have a gain of 40,000. That's a realized gain. The question is, does that go on my tax return? That's the recognition. Realized gain or loss, the difference between the amount. I just did that. Okay. All right. Okay. So, realized from disposition. I just said that to you. Okay. Adjusted basis. So let's say, for example, that Paula bought the house for $275,000. That's the basis. Well, what can adjust that basis? What can make that go up or down? So if she bought the house for $275,000, and then let's say she put a new deck in, worth $30,000. So now she's got 275 plus 30. I have to add this up because I'm not good with her new basis. Her adjusted basis is 300,000. The 275 plus the 30. It's now 300. Her basis went up. Her basis was adjusted up because she invested in the property. Well, what if there was a tornado and part of the house was gone and there was a $10,000 loss? The basis has now gone down from 300 to 290. Okay. So your adjusted basis is the property's original basis adjusted by things that make it go up or down before you dispose of it. Capital additions make it go up. Like I said, improvements, a new deck, a new bathroom, anything that's going to better the property. Whatever you paid to better the property, that's going to make your basis go adjusted up. Capital additions. Recoveries decrease. Depreciation, that reduces your basis in your property. Casualty, theft, and losses, it reduces your basis. So I have here in your Excel file. I bought a building for $900,000. Just hold on a second. I need to move something. Okay. I bought a building for $900,000. That's my book value. This is my basis, beginning basis. Then I have depreciation, which we don't have for personal, but for business you do. So 900 minus 30 is my book value on your financial statements is 870, or it's called adjusted basis. Okay, so 900 minus 30 is 870 over here on the right. And then let's say year two, B7, right. I installed central air, right? So 870. I have maintenance here of $100,000 to fix and repair stuff. Does this affect the basis? No. If you have maintenance, it does not affect your basis. So on year two, that maintenance doesn't go up. So my I bought my book value for 90 minus the 30 is my 870. Now it's year 2. I have this number here is my adjusted basis. This is my book value. So the 900 plus the 300 is 1200. Okay. Move this down. And then your depreciation is going to be adjusted with your new depreciation. And I'm just going to, I made up the number there. Okay. So this is your depreciation. This is your asset minus your depreciation. But look at how my asset has changed based on my basis going up because I installed central air. Land, this doesn't have depreciation, so it doesn't matter. So you have in your financial statements, you have land and buildings. These are properties that would have basis that goes up or down. So let's say over here, I have a basis of 1.188 and I sold the building for $3 million. My basis, my adjusted basis, my basis was 900 and now my adjusted basis is 1.18. And then I sold it for $3 million. I have a gain of $3 million minus 1188 is 1811. Okay. So that's an example of understanding basis and things going up or down. Okay. Here's some more example distributions. You can read those. So some examples of your basis going down. So which of the following computations result in a realized gain, assuming that the resulting numbers are positive? Selling minus depreciation is a realized gain. Fair market plus money received, realized gain. Amount realized minus the adjusted basis, realized gain. Fair market value plus capital improvements, realized gain. See. Amount realized, what I sold it for, minus the basis. The money that I received. So what does that mean? If I sold something for $300,000, I received $300,000. That's what I received. That's what I realized. Minus the basis of what I bought it for, it gives me my realized gain. So gain or loss. Recognize gain or loss. Recognize gain or loss is saying, of the realized gain or loss, what would be included or deducted from gross income? So all this is saying is, I sold something. I have a realized gain. The question is, do I recognize it on my tax return? Well, that would be different depending on each of the assets and what the IRS rules say with regard to, do you have to record something on your tax return or not? So realized gains and losses are not always recognized. They could be deferred or excluded, or they could be deferred or disallowed. So realized gains can be deferred or excluded, or realized losses can be deferred. So in this situation, you need to know the laws for each type of asset, or each type of property. So realized losses from the sale, exchange, or condemnation of personal use assets are not recognized for tax purposes, except if it's casualty loss. So if you have a loss of personal use assets, you cannot put that loss on your tax return unless it's casualty loss. However, any gains are fully taxable unless there's an exception, excluded for a reason. So Alice sells her boat, which she held for personal use, for $23,000. She had bought it. Her adjusted basis was 22. So she has a realized and recognized gain of 1,000. That would go on her tax return. But if it was the other way around and she had a loss, she would not be able to put that on her tax return. So Melise received dining room furniture as a gift from her friend, Alari. Alari's adjusted basis was $9,200, and the fair market value in the date of the gift was $7,000. Melise decided the furniture was not needed and sold it to a neighbor 6 months later for $6,500. So her adjusted basis was $9,200. And the fair market value the day of the gift, because she received it from a friend, was $7,000. So what should we use? What's her Melissa's recognized gain or loss? It's 0. It's a loss of $7,000. Melissa received dining room as a gift from a friend, Alari. Alari's basis was $9,200 and the fair market value the day of the gift was $7,000. She decided to start the furniture was not needed, sold it to her neighbor 6 months, which was $65,000. Melissa has a lost basis of $7,000. The lower of the adjusted basis of $92,000 or the fair market value of the $7,000 for the furniture. The sale proceeds of $6,500 resulted in a realized loss of $500, but this is a personal one, so it's not recognized because it's asking the recognized gain or loss. So basis. Again, what makes your basis go up or down? A bargain purchase results in when an employer transfers property to an employee at less than the proper. So let's say I am your employer and you work for me, and I transfer property to you and at less than the property fair market value. So let's say the property is fair market value is $300,000. And I give it to you as compensation for $250,000. Means it's less. You're getting that asset as $250,000, which is less than the fair market value, $350,000. That's a bargain purchase. I'm letting you buy it from me for $250,000. Sorry, not give, buy. You're buying the property from me for $250,000, but the fair market value is $350,000. So there's a $100,000 difference there. That $100,000 would be considered compensation to you. Same thing with the shareholder and a shareholder at a corporation. That $100,000 difference would be considered a dividend. What if you have security sales like stocks or something like that, and you don't know which one you're actually selling? You use the first in, first out to compute the basis. If you have a lump sum, go back to your time value of money and the perpetual method and the incremental method, okay? You have to figure out the allocation using the lump sum, which is the perpetual method, or the incremental method. So if the allocation is necessary, some of the assets acquired may be depreciable, but others are not. So you have to allocate correctly based on depreciable assets and not depreciable assets. If one asset acquired is sold, its basis must be known to compute the realized gain or loss. So for example, if I go and do my tax return and I receive from my broker all of these stocks that I sold during the year, whatever I sold them for, let's say I sold a stock for $50. I'm not going to pay tax on the $50. I'm going to pay tax on the difference between what I bought the stock for versus what I sold it for. So when you have acquired these assets, the basis must be known to figure out the gain or loss. All right. So allocate using the fair market, the perpetual method or the incremental method based on the fair market value. If a business is purchasing, goodwill is involved. A goodwill, so let me go back to here. I want to go through this, for example. Go back to this, for example. If you want to delete these. So let's say you're single or married filing jointly. Here's an example of an exclusion. When you have a house that you bought for $350,000 and you sell it for $700,000, you have a realized gain of $250,000. Well, there's an exclusion. I've realized the $350,000 in gain, but do I recognize the $350,000? In this example, if it's a residential house and you follow the rules of what they are, which means you have to live in the house for 2 out of the last 5 years, there's an exclusion rules for residents. If you're single, you get to have an exclusion of gain of up to $250,000. If you're married filing jointly, you have an exclusion of gain up to $500,000. So if I bought the house for 350, I sold it for 700, I've 700 minus 350 is 350. I'm single, so I have an exclusion. I don't have to recognize the whole 350. I subtract 250 from that, so I only have to recognize 100. So I've realized 350, right? I received $700,000 minus the basis. I realized 350. But I recognize 100 because a resident house has a rule of exclusion. Married filing jointly. I bought it for 300. I sell the house for 1.5 million. I get a realized gain of 1.2. Well, I'm married filing jointly, so I have an exclusion of 500. So I'm not going to get taxed on 1.2. 1.2 minus 5 is 700. Recognize means what's on my tax return. So I want you to do single for this one, married filing jointly for this one, single for this one, married filing jointly for this one. And I want you to pause this video and I want you to then go do these ones and then come back and see if you got them right or wrong. Okay, welcome back. So there's your answers. Okay, and this will be saved. The answers will be saved for you onto the Excel file. Accrual, which is not necessarily tax. Sometimes it is tax, right? What is the sale of $1,000 of merchandise on account? What's the journal entry? If it's debit account receivable, credit sales. Generally realized until cash is collected, but there's always an exception. Once the cash is collected, it's recognized. You talked about that in another chapter, right? So let's talk about this goodwill. What is goodwill? You assign the purchase price of the assets based on their fair market value. Then assign the rest, whatever's left over, to the purchase price for goodwill. So here's an example. I'm going to buy a building. I bought a business for $300,000. I bought a building for $300,000. I invested $45,000 on the new floors. I had depreciation of $190. My adjusted basis is $155. I sell it for $600. $155 from $600 is my realized gain is $445. That'll be this is chapter 15. Right now we're doing chapter 14. Recaptured depreciation. Wait, I want to come back to. Let me come back to that. I want to go to this goodwill. Goodwill is right here. So I have a business I'm selling and you're the buyer and you want to buy it. Okay. So I have my basis, which is my book value of cash of 10,000, accounts receivable of 100, my building minus my depreciation is 300. This is my assets minus my current payables is your net assets. Your assets minus your current payables or current liabilities is net assets. So 410 minus 30 is 380. Well, I want to know what's the fair market value of those things, because am I going to sell my business for $380,000? If my building, I bought it for 300, but it's worth $1 million. So 10 cash is cash. Accounts receivables might be higher or lower. My building is worth $1 million and my accounts payable is worth 20,000. So my actual net assets is 1,90,000. Am I going to sell this business for 380 or for 1,090? Or am I going to sell it for something higher? Right? So you use the basis here. It says here, you assign a purchase price to assets, not including goodwill, based on their fair market value. So I want to sell it for more than one. So I'm going to say, you know what? I'm going to say, I want to sell it for $2 million. Well, the $2 million that I'm going to receive versus the 190, the difference is goodwill. Okay. So it's equal this minus this is your goodwill. That's your goodwill. So now you bought it from me. Okay. You bought it from me. So now on your books, you're going to move over the cash, accounts receivable, the building, and then you put this asset of goodwill in there. This 910 goes over there. And your accounts payable. So now your net assets, the 2 million equals the 2 million to what you bought it for. That's goodwill. Okay, that's goodwill. So that's what they're talking about here. Your basis in the business, if you have goodwill, that's also a basis in your business when you buy it. Non-taxable stock dividends. If you get a dividend from a company like cash or something, that's taxable. But sometimes you might receive a piece of stock. They might give you a stock instead. Okay. So the basis of those shares that you receive is allocated over the original and new shares. So you received some more shares. So whatever your original versus your new gives you your new basis. So those are just examples of basis, okay? Okay. So gift basis, 8 slides, okay? It's very, very simple though. If somebody gives you property as a gift, you are the donee. The basis, the donee of the gift, you receiving it, has paid nothing to take ownership of the asset. That's a gift, okay? If you've paid something, it's a sale. So under the cost basis provision, your donee's basis would be 0 because you paid nothing. If you, the donee, turned around and sold that property, all of the amount realized would be treated as capital gain. So they give you a car worth $20,000. Your basis would be 0. You turn around and sell the property, you have for $20,000, you have a $20,000 gain. Okay. And this basis is depending on the date of the gift, the basis of the property to the donor, the amount of the federal gift tax paid, and the fair market value of the property. Okay. So that's just the high level, but there are exceptions. If the fair market value of the property on the date of the gift exceeds the donor's basis, then the recipient's basis is a carryover basis. So if the fair market value is greater than the basis, then you'll receive a carryover basis of the recipient's basis. I want to clarify something here. The cost basis provision is something different than the gift basis provision. Okay. So I misquoted there. So if you have a gift, we're going to determine what your basis is based on this slide here. The cost basis provision is a basis would be 0. That's a different kind of basis. Okay. So for the gift basis, the fair market value, the car could be sold for $20,000, but the donor's basis is 15. The fair market value is 20. The donor's basis is 15. Then you will receive, if you receive that car, you will receive a basis of 15. If the fair market value of the date of the gift is less, let's say the fair market value is 15, and the basis is 20, meaning the donor's basis is higher, then there's a special dual basis rule. So I have it here in an example here in my slides. Gift basis for a subsequent gain. It'll depend on whatever you receive. Okay. If you receive an asset as a gift and the fair market value is less than the donor's basis, Your basis for gain or loss is going to differ depending on what you sell it for later on. Your basis, so you're going to have to keep track of the fair market value of the property and the date of the gift and the donor's basis. And you just keep track of that. And then when you go around down the road and you want to sell it, depending on what you sell it for, if it's a gain or a loss, depending on what it is, that will then determine which basis you use, the fair market value or the donor's basis. Okay, so this is the gain versus the gain basis. So if you come down here, put it over here for you. Gift. Okay. So let's say, for example, mom's basis is $275. This is for a gift. And then the fair market value on the date of gift is $300,000. Okay. So the fair market value is greater than the basis, then the recipient receives the carryover basis. So you would receive a basis of $275. So that means in your books and records, you'll write, I got this gift and the basis is $275. And then later on down the road, if you sell it for $300,000, then you have a gain of $25,000. Okay. Second scenario. The basis is $275, but the fair market value of the date of gift is $250, which means the fair market value is less than the basis. $250 versus $275 is less than. Then the special dual rates apply. Basis for gain and loss may differ. Basis is dependent on relationship between the fair market value of the date of gift and the dual. That's these two things. So here's the gain or the gain. Here's the loss, the loss. If the daughter turns around and sells the asset, the basis for calculating any gain is the donor's adjusted basis. So if she sells it and has a gain, the basis for calculating any gain is the donor's adjusted basis. So she's going to be using $275. Okay. The holding period for the donor, the holding period or the donor transfers to the donee of, should be up. Okay. So the holding period, if the mother had this house for 20 years, then the holding period would carry over. It would transfer. It would be 20 years plus however, whenever they got it. So 20 years. Now, if the daughter sells the asset at a loss, the basis for calculating the loss is the lower number between the fair market value and the adjusted basis. So in this example, which is lower, the fair market value of the basis, it's the fair market value. So the loss would be a smaller loss. Okay. So when we're calculating a gain, it's usually going to be 275 is greater than 250. So it'll be a smaller gain. And this would be the lower number, 250 versus 275. It'll be a smaller loss. So what these rules are trying to do is we're saying, listen, this is a gift, okay? And if your basis of the gift that you receive is 275, that the person that gave it to you, their basis is 275, but the date of the gift, the value is 300,000, then you're going to get the basis of 275. You're going to get a lower amount. It's kind of a little bit of a dig. But if it's the other way around, that you're getting an asset that's worth less than what they paid for, then they're going to give you a smaller gain by using the lower number, a smaller loss by using the basis number with the high, which is the higher. If there's no gain or loss, then it's the difference between the fair value. So there's no gain or loss. Okay. And that's kind of how that works. That's what these slides are telling you. All these slides are telling you. Now, if I gave you a gift, I have to put that on my gift tax return and I have to pay the taxes on it, except for where there's the exclusion for, I think it's $17,000 this year. Depends on the year. If my federal gift tax are paid on that transfer, the portion of the gift tax that I paid is related to any appreciation is going to be added to your gain basis. So over here, this gain basis, if I paid a gift tax on this, you have to add it to your gain. So it's basically you get punished for giving a gift, really. Here's an example. Alex receives a gift from Beth on June 15th this year. The fair market value of the asset was $8,000. Beth bought the asset for $10,000. Fair market value was 8, bought the asset for 10. If Alex sells the asset for 11, which is a $1,000 gain, 11 minus 10, you use the higher number. If she sells it for 7,000, you use the lower number to have a smaller loss. If she sells somewhere in between the 8 and the 10, which is 9, there's no gain or loss. If the daughter sells the amount is between the fair market value, there's no gain or loss. So let's do that again. The fair market value is 8. The basis is 10. If you sell it for higher than the higher number, you use the higher number to have a small gain. If you have a lower number, you use the lower number to have a smaller loss. If it's in between the two numbers, then it's nothing. Okay, so that's a gift. Inherited property. Inherited property. Now, up here for a gift, I said it's the basis or the fair market value, depending on what you would sell it for in the future. Inherited property, if you receive inherited property, your basis is going to be the fair market value at the date of death, which is called the primary valuation date, PVD, or the alternative valuation date, which that has to be elected by the administrator of the will. The AVD date is usually used and it's got to be 6 months after the date of the death. That's the alternative date, 6 months after the date of the death. It can only be elected if both the value of the gross estate and the estate tax liability are lower than if the PVD was used. So sometimes you might be able to determine, okay, the value of this property right now is $300,000. But if we choose the AVD date, I know the value of this property is going to be less. The value of the estate and the liability are going to be less. That's when you can elect to use a different date for the value of it. And then the PVD date, the holding period is always long-term. But you want to choose the AVD date. The choice is the AVD date, right? So the basis of the AV is chosen when will be the earliest date between the fair market value and the AVD date. So the AVD date is alternative valuation date. So what's the holding period, right? So if my date of death is January 1st and my distribution is April 1st, which date do I use for the basis? If I choose the AVD date, let me just, hold on, take this out. So if the date of death is January 1, but my AVD date is July 1, which date do I use for the basis? Because I'm looking at the value on July 1, the value on January 1. The basis, if the AVD is chosen, will be the earliest date between the fair market value of distribution date and or the fair market value of the AVD date. So the fact that this was distributed on April 1, so see what you think your answers are, and then pause this video and you can come back. All right, welcome back. So because My January date is 1, and we're choosing the AVD date. My basis has to be April 1 because the distribution happened before the AVD date. So the distribution date overrides. This is what we're saying. The choice is the AVD date. We're saying we're choosing the AVD date. But the basis will not be the AVD date because the distribution happened before the AVD date. Here, the distribution happened after, so it's the AVD date. This is before, so you use the distribution date. Okay, that's what all of these are telling you. You can read those examples to give you more examples. Survivors share in community property. So let's say my friend and I both own property, community property, and then I die. Well, how does that work? Well, let's take this example for surviving spouse. Let's say myself and my spouse and I die. Well, our property is community property unless there's a prenup, right? But you cannot disinherit a spouse in a will, but you can create a prenup that says what they will get or not get or something, right? So both the decedent's share and the surviving spouse is called community property, and they have a basis equal to the fair market value on the debt of the decedent's death. So if I die, the value of our property is now going to transfer to my spouse the fair market value on the date of my death. It's deemed as being acquired by me. The surviving spouse is deemed to have acquired the property from me. That's in a community property state. If you're in a common law state, each state is different depending on these rules. The federal government's the same, but for states, it's different. Sometimes a community property state, sometimes it's a common law state. If it's a common law state, only half of the jointly held property of the spouse is included in the state. Okay, because it's a common law state. No adjustment is permitted to the surviving spouse's share. The surviving spouse's share is their half. They continue on. So Alice and various family members inherited property from Paula, who died in 2023. At the date of death, Paula's basis for the property Alice inherited is $275. The fair market value was $475. So that means that because Alice is receiving the property, she's going to get a stepped up basis. Alice's basis is $475. Because she receives property, she receives the fair market value of the date of death or the AVD date. But here they're not talking about an AVD date. So when the house transfers to Alice, her basis in the property is going to be $475. And there's an example there that you can look and use. So disallowed losses. And have that here. Disallowed losses. Okay, related parties. So a related party could be a family member. It could be a corporation and a shareholder. It could be a partner in a partnership. It could be, a friend, generally is family members. But if you have a realized loss between a related party, they're disallowed. Okay, because it's generally found that the reason why this transaction is happening is to create a loss, to create a deduction, to lower your taxes. So they're generally disallowed. It prevents a taxpayer from directly transferring unrealized losses if they have a higher tax bracket to reduce the taxes that they will owe. Now, if you transfer an income producing or business property to a related party and there's a loss, it's disallowed. Now, they do allow that if you have a disallowed loss, but you have an allowed gain, that you can offset the disallowed loss against the allowed gain for income producing or business property. It's only available to the original transferee, not available for sale or personal use assets. So here I have I had a disallowed loss in here. Where to go? Right up here. So, related parties. So let's say you had a loss. Let's say you had a loss that was disallowed of $3,000, and you had an allowed gain of $4,000. You'd be able to net this to say equals 4, so that you'd actually have a gain of only $1,000 versus the $4,000. Okay, that's what they're talking about there. So right to offset it. The holding period for disallowed loss. They're not really affected because you're not allowed to actually have a loss. But since you're transferring the property, the holding period of the buyer for the property is not affected by the holding period of the seller. But the buyer's holding period includes only the period of time he or she has held the property. So if I bought some property and then later on I sold it, however long I held it would be my holding period. Now, a wash sale. Realized losses from a wash sale are disallowed. So here's how a wash sale works. This is when you buy stock and then you sell it for a loss, but then you turn around and buy the same stock within 30 days of that sale. You're punished. You can't do that. You have to own the stock. It's like you sell it for a loss and then you turned around and bought the same stock. Well, if the stock is going down in price, you want to stop the loss from happening by getting out quicker, getting out to not have more loss. And then you turn around and buy the stock at a lower price. They don't like that within 30 days. So you have to wait till 31 days, right? So let's say you bought 5 shares and your basis is $50. Okay. And you had a disallowed, your new basis is $50. And then you sold it for $25, you had a loss of $25. Then within 30 days, you bought 5 shares for $20. That $25 of disallowed loss, if you sold it again, that $25, what happens is if you bought the shares for $20, you buy the same stock within 30 days for $20. That disallowed loss of $25 you have to add to it. Now your basis is $45, so that you actually get punished for that for that loss. It gets added to your basis. Okay, that's what that's talking about. And that's what these slides are talking to you about. So that's the big picture. Alice owned 100 shares of Green Corporation stock. Her basis was $20,000. She sold half of those shares. So she had 100 and she sold 50 of them for $8,000, right? So that's a loss because 100 divided by 2 for 50 is 10,000. She sold it for $8. So she had a loss of $2,000. 10 days later, she purchased 50 shares for the same stock at $7,000. So she has a realized loss of $2,000, which is the 10, right? Because 100 shares, this is 50. So half of this is 10. 10 minus 8 is 2. That's her realized loss. It's not recognized because she bought the shares within 30 days. And the newly acquired stock that she paid $7,000 for, that loss that she wasn't allowed is added to it. 7 plus 2 is 9, which is what I showed you here. Assume the same facts in the previous slide, but instead of purchasing 50 shares for $7,000, $140 per share, Alice purchased 40 shares, which is 40 times 140. She only replaced 40 of the 50 shares. So only 40 out of 50, only 80% of the $2,000 difference would be a realized loss, is disallowed because she didn't sell all the shares. So she'd only have a 40% loss, which is 2,000 times the 20, because only 80 is disallowed. So her basis would be 7,000 plus the 200, sorry, the 400. Sorry, the 5,600 plus the $1,600 disallowed. 56 and the 1,600. Okay. So what happens if you have property that you convert from personal use to income producing, to business or income producing? The personal use asset, when you dispose of a personal use asset, the loss is disallowed. So if you convert it from personal use to business at a loss, it's like you're selling it, it's disallowed. The personal use asset cannot be converted into business use for a deductible loss. So they want to prevent you from taking personal use assets, making them business, and getting a loss out of that. So the original loss basis of an asset is converted to the lower of the adjusted fair market value, the fair market value date of conversion. So whatever that basis was, whichever is the lower number will be your new basis. And there's some knowledge checks for you. So focusing on the big picture. Alice inherited the house from her mother, Paula. Because she inherited it, the rule is fair market value. So Alice's basis in the house is $475. Now, several real estate agents said the house is likely worth $485. And Paula lived in the house for 38 years, which it doesn't matter how long Paula lived in the house. Well, it does. That means it's a long term, which means Alice is going to get a long term. So Paula's adjusted basis is $275. Paula's was $275. Alice is going to be $475, but there's also this $485 number we have to think about. As a child, Alice lived in the house for 10 years, but she has not lived there during the last 25 years. So she cannot do the exclusion that we talked about as a residential one for the 250 or the 500 because she has to have lived in the house for 2 out of the last 5 years, and she hasn't done that. The house has been vacant for the last 7 months that she's owned it. Alice is trying to decide whether she should sell the house. Alice suggested $275 to Dan. Well, she's going to have a gain because the fair market value is $475 minus the $275 is a $200,000 gain. 45, but it's going to be the amount realized is $485. Her basis is $475, so she has a recognized gain of 10. If she sells the house for $485, she'd have a gain of $10,000 because her basis is $475. And it would be long term because she gets her mother's holding period. If she decides to sell it to the nephew for $275, she'll have a part sale, part gift. So this is where you do the proportional method. So the gain is going to be 56, right? So her amount realizes $275 because she's going to sell it to him for $275. That's what she's realizing. But what's the basis? Well, The 275 that she's realizing divided by the 485 she could have realized if she sold it gives her a percentage. Multiply that by the fair market value is 269,330. That's her adjusted basis. So if she's deemed to have made a gift to Dan of 210, the 485 minus the 275, because she could have sold it for 485, but she gave it to him for 275. The difference is 210. So with all this information, what does she want to do? How much of a gain does she want to have? 5670? Or pay a gift on a gift tax on 210? Okay, so that is chapter 14. And if you have any questions, please always email me or at tara.foley1@lehman.cuny.edu. Hello, Accounting 442.